Thank you for having me, everyone. And happy Chinese New Year and happy Carnival. I'm particularly happy to see both of those occur this week. Most of our markets are closed, and it's nice to sit out some of the volatility for a change, even if only temporarily. Thank you, Cindy. And as Cindy mentioned, my name is Chad Cleaver. I'm a portfolio manager at Driehaus Capital Management within the Emerging Markets Group. At Driehaus, we oversee about $3 billion in assets in emerging markets, comprised of 3 different strategies. The first being a long-only, multi-cap emerging markets fund that launched in 1997. The second is an emerging markets small-cap strategy, which is constructed to be long-only, or long-biased, but hedges approximately 10 to 40% of the risk through macro-based strategies. And then the third is our frontier markets strategy, which launched in 2014. Within this group at Driehaus, as a firm, we focus on growth investing, and specifically we believe that markets inefficiently discount securities during periods of rapid change. And this is due to behavioral biases held by investors, such as the availability heuristic, anchoring, overconfidence, and consequently we seek to take advantage of these biases in seeking out inflection points in periods of fundamental acceleration. So I'm very excited to be here with you today to share our views on emerging markets. I know it's been a difficult space for some to navigate in recent years. There's been a lot of macro-related developments that are now impacting other parts of the world as well. And so, at the beginning of every year, we sit down as a team and we think about different themes that we expect to play out over the course of the coming year. So I thought that I would take today as an opportunity to share with you some of our insights and some of our different themes, be it macro-related, stylistic, and also industries where we are finding opportunities today to invest within emerging and frontier markets and have a nice free-flowing dialogue. So feel free to jump in with any questions along the way, and I will also reserve some time at the very end for additional Q&A. So with that, I'd first like to highlight some of the macro themes, and I won't belabor a lot of the points about how we got here, but I do want to cover a couple of those. And I will say at the outset that since about middle of 2014, one of the most meaningful impacts on emerging markets has been the drying up of US dollar-denominated liquidity in the global financial system. And this is coming from several different sources. The first is the US credit creation and the end of QE. The second being US trade deficits with the rest of the world starting to compress. And then lastly is petrodollar recycling dwindling as the oil prices have come down. So people like to grasp at headlines and things like the taper tantrum and the fragile five and the oil price crash as proximate causes of the turbulence in emerging markets. But our group believes that all of these are symptomatic of the same factor, which is a contraction in US dollar-denominated liquidity. And let's get to some of the root causes of this. And I'd like to start with China and just sort of step into our framework for thinking about China. And this really revolves around the macro theory of the impossible trinity. And we take the view that the Xi and Li administration is thinking long-term about several different reforms in the economy. SOE reform is something we've heard a lot about. Financial sector reform is something that's been important. And associated with that is capital account liberalization, the free flow of capital within what over time has been a closed but relatively porous capital account. And so, thinking about that in terms of, that is a given. One can either run an independent monetary policy or have control over a fixed exchange rate, but not both at the same time. So any two of these 3 factors can be at play, but not all 3. Within this dynamic, it's important to consider that the US at face value is on this path to tightening. They've ended QE, they've raised interest rates once, they've signaled the possibility for 3 to 4 more interest rate rises, albeit at a gradual pace. China, on the other hand, as we all know, has seen a marked deceleration in its economy in recent years. Part of that is related to these SOE reforms that I alluded to that specifically impact the manufacturing sector. there's rampant overcapacity in numerous industries in China, including steel, shipbuilding, and various types of base metals. As China is attempting to consolidate these sectors and also clamp down on the excesses, it's involved a gradual and necessary slowing of the economic growth rate. So in this situation, one would presume that China would need looser monetary policy to combat this slowing growth. Now, as I mentioned, you can only have one of these two bottom factors and not both. So in an environment where loosening monetary policy is likely needed, we can see the path of least resistance being the currency. And the offshore RMB, the CNH, is currently at around 656 when I checked this morning. Our macro analyst has kind of worked with this assumption of 680 to 7 as being an appropriate range for this year. One would note, I think the one positive factor as it relates to positioning right now is that pretty much every macro hedge fund is short the CNH. So the potential for a short covering rally is there. The potential for the Chinese authorities to quell any speculative attacks on the currency is certainly there, given these currently stretched levels of positioning. But we see this as something that is likely to unfold over the course of this year. The implications that people may not be thinking about are, in our view, for other Asian currencies, namely the Taiwanese dollar, which held up exceptionally well last year, the Korean won, which similarly held up pretty decently as compared to other EM currencies, and the potential that a weakening RMB could follow through to competitive devaluations throughout the region, as these economies seek to preserve their export competitiveness especially considering commoditized parts of the export chain. So we see this as an important factor that has implications across EM. Now, as we go on, I want to talk a little bit about how we got here to help frame the forward discussion on the macro front. And to do that, I want to step back to 2008 just briefly. In 2008, as you see on this chart, debt to GDP in aggregate in the developed world was right around 400%. This is household debt, corporate debt, as well as government debt. EM on the right-hand scale, while still well north of 100%, was a more manageable 150% of GDP. Now, since 2008 and the global financial crisis, 4 important things have happened. First, the U.S. household sector and corporate sector, to a degree, has deleveraged. Second, while that deleveraging process has occurred, aggregate debt to GDP has remained relatively flat. In essence, a lot of this debt has been transferred to the public sector in the developed world. Third, as we all know, the U.S. has undertaken successive rounds of quantitative easing, amassing $4.5 trillion of securities on its balance sheet. Fourth, in combination with this, EM debt levels relative to GDP have risen substantially. The reason behind this is that $4.5 trillion of money that was taken onto the Fed's balance sheet, those dollars needed to find a home. And there was a dramatic search for yield. And faced with low interest rates in the home markets, increasingly that money sought yield in emerging markets. And the response for EM policymakers, they faced a critical decision as this money was flowing in. First, they could allow it to flow in and cause a market appreciation of their exchange rates, undermining their economic competitiveness. Or second, they could create money in their domestic markets. And that's the course that they chose. This fueled a sharp V-shaped recovery in GDP in 2009 and 2010 in EM economies. But what it fueled today, and where we're seeing the outgrowth of this, is the money multiplier, while arguably dead here in the U.S., is alive and well in emerging markets. So this was not only base money that was taken on into these economies, it also saw a vast credit multiplier. China is emblematic of this, as base money between 2008 and 2014 rose by $3 trillion, while aggregate credit rose by $9 trillion. So you can see that this has been a major driving factor behind the increases in debt that we've seen in emerging markets. Now, added to this, if we think think about a DuPont ROE decomposition, EM has taken on a lot of debt. So this is something that should boost EM ROEs, theoretically. But the problem that we've seen today is that over the past 5 years, return on equity is stagnated in emerging markets. And this is a function of digging deeper, looking at the profit margins and the asset turnovers that we've seen in emerging markets. Those have deteriorated markedly. And so, in many ways, this has been the worst of all possible combinations, levering up in a period of structurally declining returns. And thinking about how we view the emerging market space at Driehaus, as we look at MSCI EM, we see an index that is heavily populated with companies in 3 distinct areas: commodity producers, exporters, and state-affiliated companies. These are, in essence, the poster children for this DuPont ROE dynamic that I alluded to. Now, why is this important today, and why is this all coming home to roost? Well, simply put, capital flows to EM have started to deteriorate over the past several years. If you see this black bar in 2015, and this is a forecast by the Institute of International Finance, bank credit to emerging markets is expected to contract for the first time since just after the dot-com bubble burst. So in environments where EM is beholden to policymakers in the West and the QE that they've undertaken and has seen their debt levels rise significantly, they become even more dependent on capital flow and on this US dollar liquidity point that I led with. So this is a factor that's influencing several emerging market economies right now, and most notably the kind of poster children for taking on US dollar denominated credit, such as China, Brazil, Turkey, South Africa, and to a degree Indonesia. So these are some of the macro discussions we've had, and I think that one of the key takeaways here is that you're amidst an adjustment phase in emerging markets right now, where there is, in essence, a forced deleveraging as bank credit is contracting, as capital flows are drying up. And so that's something that we see playing out over the course of this year and perhaps beyond in some of the countries that I've mentioned. And that influences the way we think about positioning, relative overweights and underweights versus our benchmark, and the types of companies that we want to own in this environment. It also shapes some of our stylistic considerations in how we approach the bottom-up stock selection in the areas that we're finding opportunities in or seeking out opportunities within emerging markets. So I want to spend a little bit of time on that as well. In short, we tend to seek out idiosyncratic growth during this period. We don't want to be tied too heavily to an industrial cycle that we see is still continuing to contract. We don't want to be tied to the commodity cycle, which we see as being relatively unattractive still at this point. And lastly, we don't want to be tied to state-affiliated companies that do not have alignment with us as minority shareholders with respect to their deployment of capital and their growth plans. So consequently, we found a greater opportunity set in recent years, which we believe will sustain going forward this year, in areas that we believe can grow in a somewhat idiosyncratic fashion to the broader macro regime. And this would include things such as healthcare, internet usage, and e-commerce, lots of different under-penetration stories within emerging markets. So healthcare is something we'll talk about in more detail later in the presentation, but this is something that we see as a long-tailed structural trend in emerging markets, partly driven by the changes in demographics. You have a rapidly aging population in China. You have an emerging market consumer that's seeing gradual increases in their wallet size and in their wealth, and they're able to treat certain lifestyle diseases that they simply haven't been able to treat in recent past. So things like hospitals, the development of pharmaceuticals, and this goes beyond what EM has historically been known for, which is the development of generic drugs, and you're starting to see more innovation unfold in this space. Internet usage has been something that's risen dramatically in China, and you've seen major investments in telecom infrastructure and mobile internet, which has been the major driving force behind internet penetration in recent years. And as we'll discuss in greater detail, the related companies are now taking steps to monetize the relationships they've made in the various platforms that they've invested in recent years. So this is another area of idiosyncratic growth that we're finding, and associated with that is e-commerce. And so those are a few that we're looking at. I think an underappreciated aspect of emerging markets broadly is the potential for innovation. While we're not claiming that the next Silicon Valley is out there and in as much in emerging markets, we do see major advances in things like robotics that will fuel efficiency gains in the manufacturing process, and things like fingerprint technology, and even parts of the driverless car ecosystem, which is another theme that I'll discuss in greater detail as we move forward. Lastly, in this tense geopolitical environment, we're seeing an increased focus on defense spending. Turkey is one of the prime examples where we own a defense contractor that is gaining major new orders from the government. Additionally, a bigger trend that we've seen is this effort to localize production. So there's been a big technology transfer from some of the multinational defense companies in partnership with the local defense providers. So if we look at India, they import about 80% of their defense equipment right now, and there's a policy in place called Make in India, whose goal is in part to transform that mix to be able to produce 80% of that equipment within the country. So we're seeing that dynamic play out in India and China as they assert their presence in the world geopolitical sphere. Along with these idiosyncratic drivers, frontier markets is an area where we expect to see a lot of these opportunities emerge. South Asia in particular is a region that we've liked within frontier. Bangladesh and Pakistan are two countries that kind of encapsulate a lot of the dynamics that we seek out in frontier, which are large populations with an underpenetrated consumption base that are now seeing either rising wages, rising consumption, or improved access to credit. And there's some different reasons behind each. Bangladesh has benefited from a shift of manufacturing capacity from China in basic goods and industries such as textiles. As the Chinese working age population has peaked out, as wage costs have risen, companies are looking to source from more cost-effective locations. So you've seen manufacturing capacity shift incrementally towards the likes of Bangladesh. We would also lump Cambodia and Vietnam into that grouping. And that's been a major driving force of increased consumption within the Bangladesh local market. Additionally, Pakistan has benefited from some different drivers. This past April, China announced a landmark deal with Pakistan called the China-Pakistan Economic Corridor, which involves about $45 billion worth of investment in infrastructure. The primary goals of this for China are to, number one, again, assert their geopolitical presence in forming alliances with a historically friendly partner in Pakistan, to also improve their access to various trade routes and increase their efficiencies in terms of exporting goods throughout the region. So as part of this, we see a major effort towards building roads and rail networks throughout the country, Pakistan, that have spillover benefits, especially in these rural communities where the multiplier effect for these investments is enormous. So associated with that, Pakistan's got one of the youngest populations in the world. It's rapidly growing, and some of the consumer industries and banking companies are of interest to us in that market. The second area we like within Frontier is various types of reform stories. In recent years, Romania has been one of the strongest areas for reform we've seen in Frontier. A lot of the reforms going forward will center around privatization, which we see as having some low-hanging fruit yet to come. And Argentina has been a very interesting story for us as well. There was a pivotal election this past fall that surprised a lot of people as Mauricio Macri won in an upset bid. And this is for the first time marked the transition away from the historic Peronist leadership in the country. It's just a fascinating story from a historical perspective, as Argentina has gone from being one of the wealthiest countries in the world to a frontier market. Now, Mark has a tall order in front of him. Inflation rates are running at 25% plus. They just devalued the currency towards the end of last year. And they have various types of regulatory regimes to unwind from the legacy government, while also trying to put themselves on better feet with their creditors. So reform stories, as we've seen in several examples in emerging markets, don't play out overnight. But this is a case where we think that going forward, the cost of, or the equity risk premium can come down markedly in a country like Argentina as and when those reforms are carried out. Lastly, Vietnam is probably our favorite frontier market for 2016. We believe that this country is in a sweet spot to actually see growth accelerate. In recent years, as I mentioned with the textile sector, Vietnam has been one of the beneficiaries of foreign direct investment coming into the country. It's got a population of 90 million plus, young, highly educated, hardworking, and multinational companies have found these elements to be highly attractive in terms of setting up manufacturing capacity there. So Samsung is now producing a lot of their components for their phones within Vietnam. You've seen other suppliers within the tech chain follow them there. And we believe that the consumer in particular is set for an inflection point in Vietnam as they start to reap the benefits of this increased employment and increasing wage opportunities. So Vietnam has a kind of added benefit of not having been part of these excesses that I described at the outset in recent years. And so we think that just from a credit generation standpoint, it also is sitting in a good position relative to the rest of EM and frontier markets. Now, frontier, we found, has increasingly gotten lumped in with emerging markets. I think that that's natural in that these are obviously developing economies, and the performance of frontier markets has been disappointing since 2014 in aggregate. We would note that a large portion of the frontier markets benchmark, MSCI Frontier, is encapsulated in two countries. Both are heavy oil-producing economies, Kuwait and Nigeria. This actually affords a very attractive opportunity as we see it. Number one, I would highlight that frontier markets are really the last remaining area of lowly correlated equity markets relative to MSCI equity. So over time, we've seen the correlation kind of fluctuate between it dipped briefly negative in 2006. At its peak, it's been 0.6. And it's tended to reside around 0.25, which is a nice benefit from an allocator standpoint. Secondly, from the standpoint of us as active managers, it's also quite intriguing because these countries don't all operate, their macro cycles don't all move in a synchronous fashion. So Kuwait and Nigeria have certainly come under pressure in recent years owing to their high level of dependency on oil exports. However, this has been a major opportunity for Pakistan, Bangladesh, Sri Lanka, Vietnam, who are commodity importers and have seen their import bill fall. And so, when we look at the intra-country dispersion, it's quite high. And so that affords us as active managers to take meaningful deviations from the passive benchmark into constructing a portfolio. So, since we've launched the strategy, we've outperformed the index by about 1,500 basis points over the last 18 months, and about half of that has come from country selection. So, we really see it as an underappreciated opportunity within the grand scheme of things from an allocator standpoint as well. The last stylistic point I would make is that we've seen since 2012 a low volatility regime in asset markets, and this is largely a function of this view of central bank omnipotence. Mario Draghi doing whatever it takes. Kuroda drawing the line in the sand on inflation, even though he's doing a terrible job meeting it. The Fed coming back with successive rounds of QE, Operation Twist, being willing to support equity markets through monetary policy. We believe that there's questionable sustainability of this at best. You now have a Fed who's attached itself to this Phillips curve-based ideology whereby they seem committed to or uncomfortable with this zero lower bound of interest rates, and focusing heavily on factors such as unemployment and wage gains, and not as much on market-based factors, which are sending a dramatically different message. The Bank of Japan faces the reality that they have securities on their balance sheet that are equivalent to 80% of GDP in the country. So one may begin to question the sustainability of additional easing measures there. And then the ECB faces practical limitations with the types of securities that they can buy legally. So while central banks will still likely try to step in, Mario Draghi is exceptionally gifted in terms of assuaging markets. Moral suasion isn't going to be enough to last in perpetuity. So this is one factor that we see that has dampened volatility over the past 4 years that's likely to change. Alongside this is brought about a tightening of financial conditions. The financial conditions are not just a function of liquidity, but they're a function of widening credit spreads, rising asset volatility, which has a reflexive nature in and of itself. So we think that the tightening of these financial conditions and the lack of policy response together are recipes for higher volatility. And consequently, we always undertake a nimble approach as active managers at Driehaus, but we think that this is of critical importance in an environment like this. Moreover, we've found that in our EM small cap portfolio, the hedging strategies that we employ really give us a convex approach to this rising volatility regime. And so we think that the nimbleness and flexibility within an investment approach will be of growing importance in this environment. So I've painted probably a fairly pessimistic, but I would say also an honest picture of emerging markets and some of the issues that we face and are confronting collectively are starting to spill into the developed world as well. I do want to spend some time on industries where we are finding opportunities, because all is not lost. There are industries that are growing independently of the macro regime and environment, and we think that there are good opportunities out there going forward. The first industry I'd highlight in Asia is the growth of auto electronics. This is in part driven by increased safety regulation, and this encompasses things such as parking assist systems, pretty much the sole reason I haven't crashed my car 20 times trying to parallel park at this point. Also things like tire pressure gauges and various types of sensors and cameras that go into the automobiles to enhance the safety features. Broadly, this is called advanced driver assistance systems, and there are companies in Taiwan that are at the forefront of this technology, which is essentially marrying technology and software with the auto supply chain. One such company that we found when it was about $250 million in market cap was Tung T. It's an ADAS supplier in Taiwan that makes these parking assist systems. They have integrated software capabilities for which they filed patents. And while ADAS is still in its relative infancy, it has major implications as we move towards this driverless car ecosystem in the coming years. So as we see it, today ADAS is simply a line of defense. It's a basic camera that helps us park our cars. But as we advance and make innovations toward the driverless car, even if we don't get there in this projected time frame or if ever, these are the types of innovations that we'll see and the type of growth that can accompany a trend like this. So we like a lot of these different types of suppliers within the auto supply chain in North Asia. Another one of our themes collectively has been the notion of being R&D heavy rather than CapEx heavy. In general, we like to see strong business models that can generate cash and yield high return on investment capital. In this environment, the asset-light approach has worked well, specifically in a couple of key areas. Healthcare, I talked a little bit about already, but we would underscore that the opportunity set in emerging market healthcare is changing and rapidly moving towards one of innovation. In this backdrop, with EM aging at nearly twice the rate of DM as demographics change, the growth rate of this EM population in the over 65 camp is expected to grow at almost twice that of DM in the next 20 years. At the same time, as we know, that the propensity to spend is much higher from this age cohort as they require additional levels of treatment, and as I mentioned, the overall penetration rates of a lot of these types of treatments are quite low in EM relative to DM. So this is something that we're seeing unfold in a number of industries, and you can see the penetration rates are quite low in a couple of them. I've highlighted here in China. So chronic kidney disease is something that is a very serious problem in China. You can see the number of CKD patients is, I think, 120 million in China. Well, and it's about 4 times the size of that in the US. But the treatment rates are relatively low. And this is a function of several things, including the advances in just medical care as a whole, and also the insurance schemes that are set up to cover things like this. But we would assert that part of Xi and Li's goals are to bring about increased social goals, social stability. Things like improving the caliber of the environment, and also, along with that, improving the caliber of the healthcare and social safety net. So as these advances unfold, we think that there's a large structural growth opportunity in China for things like chronic kidney disease, and also for the plasma market in general, which displays the same type of growth and penetration potential as these policies come into play in the coming years. And it doesn't matter if China's industrial economy slows from 7% to 5% to 3%. These are areas that we see as being able to grow independently of that macro regime. Another area is, of course, the internet. And here we've tended to favor the larger players, such as a Tencent, for instance, that have the scale and really have the platform basis for their companies, as they're monetizing a lot of these investments, be it through payment systems, be it through gaming, and increasing the interaction with their clients. So associated with this, last mile type of delivery of services is a growing trend. We've seen this online to offline movement where people can order food or fresh flowers or maid services, et cetera. And this is something that's increasingly being done through these internet platforms. And underlying this as a big picture driver is 4G penetration, which is enabling the growth of mobile internet and faster speeds as data pricing continues to fall, driving the growth in a lot of these different services. So this has implications for numerous different areas. Mobile games, one of the larger themes we've seen in emerging markets is the demand for entertainment has grown at an increasing rate. This would include mobile games. This would include cinemas, where Chinese box office receipts are set to overtake the U.S. And then associated with that has been the growth in advertising that we're seeing as an ancillary service tied to that. And then lastly, as I alluded to, the online to offline channel, essentially blending traditional retail with e-commerce. So again, these are a few areas that we see as having strong growth potential, somewhat asynchronous to the overall macroeconomy. So to conclude, many of our themes, be it deleveraging, the search for greater efficiency in the manufacturing process, continuation of the contraction in the manufacturing economies and the low commodity prices, point to a continuation of this deflationary backdrop in global markets that we've seen since 2011. Consequently, broad EM, as I defined it, and I mentioned MSCI's definition of EM, may struggle in this environment, and we've made the macro case as to why we believe that is. And this leads us to look for more idiosyncratic sources of growth, be it industry-specific, company-specific, or in areas like frontier markets that offer correlation benefits relative to broad equity indices. Lastly, we would underscore that this type of environment requires a nimble approach and a flexible approach to navigate this type of regime. And then lastly, I would just underscore that despite these challenges, there are a lot of opportunities within emerging markets that we think are overlooked by managers today, and that can grow on a more structural basis, and that we continue to find as attractive investment destinations for the year 2016 and also moving forward. So thank you very much for your time today. It's been my pleasure to come here and speak with you and share some of our thoughts on emerging markets. And with that, I would open it up to any questions that you might have. Thank you.
Thanks, Chad. Very good. Could you touch on, you haven't really talked about Latin America, any opportunities there, except for Argentina, of course, and then anything in Eastern Europe or in Russia that would be of interest?
Yeah. So in Latin America, certainly as a nation, there's a heavy influence of commodities in the mix. Chile is a large copper producer. Brazil, their terms of trade and consequently their currency is moved almost in lockstep with the iron ore price. Large parts of the continent have also suffered from what we would characterize as a suboptimal policy mix. And taking Brazil as an example, the policy prescription has been heavily tilted towards that of a populist regime, trying to prop up what's already an unbalanced economy that's heavily reliant on consumption and not really allowing market clearing forces to play out. This has been challenging because it hasn't created the kind of growth that the policymakers would have maybe expected when they undertook those policies. But what it has done is led to sticky inflation rates, especially as the currency has remained weak. So Brazil is in this awkward position of having interest rates that are north of 14%, but an economic growth rate that's firmly in contractionary mode. So in that backdrop, paradoxically, one of the things that we're encouraged by is the fact that unemployment is starting to rise, and that Brazil is generating trade surpluses as a result of crushing its own domestic demand. This is a necessary precondition to that market clearing mechanism that I alluded to. While there's there's perhaps a less appealing opportunity set today, we've tilted more into what we deem as higher quality and more visible companies within a place like Brazil. It's led us to shift our allocation in Latin America to a country like Mexico, where you've seen a relatively healthier economic makeup as FDI has flowed in, especially in the auto space. And Mexico also has one of the most underbanked populations within emerging markets. So in terms of relative opportunities within Latin America, we continue to prefer Mexico. And we continue to look at the commodity-producing countries with a degree of skepticism at this point. As regards Eastern Europe and Russia, it's kind of the flip side of Brazil, and what could ultimately play out in Brazil as the deleveraging unfolds. The CE3 economies, or Czech, Poland, and Hungary, have seen quite their own deleveraging phase alongside parts of Western Europe over the past several years. And this has put those economies on better footing going forward. And we would see a place like Poland, albeit having some issues with the regulatory regime in the banking sector at the moment, as being among the more responsibly managed economies within emerging markets. The opportunity set, specifically in stocks that have sufficient liquidity, is not enormous, but we would favor companies within the retail space in an economy like Poland at this point. And Hungary is also a place that is really one of these poster children for an over-leveraged economy back in 2008, and has seen market move towards deleveraging. So we find some attractive opportunities in the financial space within Hungary, but these are not the deepest markets in EM. So there's only a handful of stocks that one can buy to gain exposure. Russia, we see as being a bit mixed. It's got the heavy commodity price influence, of course, but the market is down significantly and down more in local terms than most emerging markets. And also as a result of the weak currency, that's enhanced their capabilities as an oil producer and enhanced their cost advantages. So they've been able to perhaps weather the storm a bit better than many have thought. And within our kind of recovery growth bucket, as we allocate across different types of growth companies, we found a handful of attractive opportunities there.
frontier markets? First, how do you distinguish between emerging and frontier? How do you guys define that internally?
Yeah.
And then in terms of frontier markets, obviously they have different risk characteristics. What are you looking for specifically when you think about what markets to enter and what to think about when you're investing in a particular company in that market?
Yeah. So, we work pretty much in tandem with MSCI's definition of frontier with a degree of flexibility. I mean, within frontier, there's two broad characteristics that one is looking for. And first is economic development, and the second is capital market development. So, UAE and Qatar were upgraded to EM in 2014, and prior to that, being in frontier markets didn't make a lot of sense because at face value, very high per capita income, a lot of oil wealth, but it's just the market characteristics of those individual equity markets were not up to standard with EM. So there's a couple of different features that we look for when thinking about how to define a frontier market versus an emerging market. In terms of where we would seek opportunities at the country level and the types of characteristics that we're looking for, we recognize that sometimes the political regimes will be a bit messier than what we see even in EM and also the regulatory regimes. So we try to work that into the equation and compare. You can think about a continuum of these types of factors. We also look at the external forces that impact these economies, because we found that to be perhaps even more important in some cases than the regulatory regime. And Nigeria could have it doesn't, but it could, let's say, have a great political and regulatory regime. It's still going to face the headwinds of $30 oil. And then lastly, we look at the degree of corporate governance and the types of corporate behavior that we see. So a country like Pakistan actually has some of the best management teams that we've seen throughout Frontier. And these are companies that pay oftentimes 10% plus dividends. They're very shareholder friendly. They exhibit high returns on equity, and they deploy capital in an intelligent manner. So we look again at how is the company deploying capital, what types of investments do they make, and how much of that really accrues to the minority shareholders. Unfortunately, I'd have to say that this is an area where Vietnam falls behind, and if we could see a chance for Vietnam to improve on the corporate governance scale, I think that the potential for that market is tremendous, even though I do like it on the macro front.
Are there any markets that you just completely stay away from that you just say, we're not going to touch that?
No, I mean, we try to keep an open mind. I mean, there's nothing that really has scared us off. I mean, we've in the past been involved in a place like Zimbabwe. So we found some corporates that we liked. So, that being said, there's kind of a time and place for a lot of these markets. So nothing that we'll structurally or systematically avoid, but there are certainly places where we'll take a pronounced underweight. And say probably Nigeria comes closest to the place that we would be structurally underweight, certainly in this environment. Yeah.
Chad, you talked about, obviously, they get together and you identify themes that you would like to move into for the year, and you highlighted some countries and different sectors. But can you talk about some of the changes that you did make? What are some things that you liked a year ago that you've moved away from and moved off of?
Yeah. And I think one area that we have really liked in the past several years has just been the consumer. And in fairness, we do continue to hold an overweight in the consumer sectors, but part of the driving force behind that is we've started to see incrementally some areas where the growth is beginning to deteriorate, or perhaps the quality of growth is starting to show some signs of stress. So one example is credit-sensitive retailers. Where we are in the credit cycle, you're starting to see retailers that maybe have captive credit businesses or are higher ticket types of items that are reliant on credit conditions, starting to show some of the strains of that. So that's one area. Also the textile space, it was a strong theme for us in 2015 as we saw this shift of manufacturing activity, especially in Asia, to a place like Cambodia and Vietnam. We still like that longer term, but right now, cyclically, the pressures that industry is facing is a very high inventory to sales ratio in the U.S. which is a primary end market. So we're cognizant of that when we formulate our investment conclusions, and that's something we do from altogether.
Tell a little bit about China, overweight, underweight, where do you see opportunities aside from the international space?
Yeah, we've been underweight. We do see opportunities in addition to internet and healthcare. I'd say the third one is environmental services. And there's a big trend towards improving both the caliber of the air and also the cleanliness of the water. And this is a tough area to navigate because a lot of the companies focus specifically on municipal or government-related contracts that imply a lower return. They consequently lever that up to seek a higher return on equity, and that can prove to be a dangerous game in this type of environment that I laid out. The one company that we have in our small cap portfolio is called CT Environmental Group, and they cater specifically to the private sector and industrial parks in terms of water treatment. So they offer a centralized solution to textile mills, paper plants, people who are emitting the wastewater. And one of the driving factors behind CT's growth and the growth of the private sector is that the government is now issuing quite punitive fines for corporates that do pollute, and making a big effort to crack down. So this has created an opportunity for a company like CT to earn 20% plus real unlevered IRRs from their service, which is quite attractive relative to the opportunities set in China.
Just a short follow-up on Hong Kong. Any thoughts on the peg and how that might go?
Yeah, and so I mentioned it yesterday. I think China has the tools at its disposal to quell speculative attacks on the offshore RMB. The issue with that is it's sort of like playing a game of whack-a-mole. So the unintended consequences of doing that is that you clamp down on interbank liquidity in Hong Kong. And we've seen a similar episode unfold in January where they tried to stop the speculative attacks. The consequence of that is that the Hong Kong interbank rate shoots through the roof, to the HIBOR. And why is this important? Well, Hong Kong has seen a huge increase in property prices, and a lot of those mortgages are tied directly to HIBOR. So the unintended consequences of trying to solve one problem may lead to strains elsewhere. That being said, I don't have an extremely strong view on the Hong Kong dollar. I think a lot of these pegs, it's going to take a lot to break them, and I feel that again the HKMA has some of the resources to at least counteract the speculative speculation against the peg. But it's something that's going to be pivotally important because there's pegged exchange rates all throughout the world, and the unraveling of those, even though it's maybe not a base case of myself or other investors, should that to happen, has significant deflationary consequences and also significant consequences for the local economies. So that's probably one of the biggest things that people in this space will be watching this year.
Sorry, one more. Philippines, any thoughts on, obviously, the elections coming up? Obviously, it was a grower the last few years.
I'm sorry?
For the Philippines?
Oh, yeah, the Philippines. Yeah, no, Philippines is interesting. It's a hotly contested race, and it seems like Philippines is perpetually in campaigning mode, even when they do have a leader in office. Key, I think, for the Philippines is since the Asian crisis in the late 90s, there's been a dramatic underinvestment in infrastructure. And I think each of the candidates has a kind of continuum of where they stand in infrastructure development, but irrespective of who wins, that's an area we see as being a beneficiary post the election. And I think that's a sort of obvious area for them to increase spending on. And the Philippines has been one of the darling markets in recent years. It's not cheap, but in terms of where you can find visible growth that has some of the best macro fundamentals, it's a place that we continue to like. Well, thank you again, everyone. It's been my pleasure.